Ladies and gentlemen, thank you for being here today. I want to begin with a simple but uncomfortable truth. History doesn't repeat, but it rhymes. Across centuries and civilizations, when excessive debt, declining trust, and poor policy choices converge, powerful crises follow. What we are witnessing now in America may well be one of those moments. The story of every major financial crisis begins with debt. Over time, debt grows faster than income because borrowing feels easier than producing. At first, this creates the illusion of prosperity. People spend more, businesses expand, and governments finance programs without facing the immediate burden of higher taxes. For a while, everyone feels wealthier, but underneath, obligations pile up. Debt is not free. It comes with the expectation of repayment, and when income doesn't grow enough to service that debt, the cycle starts to turn. This long debt cycle unfolds over decades. In the early stages, borrowing fuels productive investment and expansion. In the middle stages, debt begins financing more consumption than productivity, creating imbalances. By the late stage, the system becomes fragile. Interest rates fall near zero to keep the game going, central banks print money to mask the strain, and asset prices inflate well beyond fundamentals. At that point, debt levels are so high that even small shocks, a recession, rising interest rates, geopolitical disruption, can trigger a cascade of defaults and panic. The danger is not just the numbers on balance sheets, but the psychology that accompanies them. When people believe borrowing can continue indefinitely, they ignore risks and reinforce excesses. But eventually, reality breaks through and the adjustment is sharp. Debts must be reduced through defaults, restructuring, or inflation. None of those are painless. The burden shifts, trust erodes, and economies reset, often violently. Today, America finds itself at the late stage of this cycle. Household debt, corporate debt, and government obligations have reached extraordinary levels, while the tools to extend the cycle, lowering rates and printing money, are nearly exhausted. This is why the warnings of a looming crisis are not abstract theories. They are reflections of how debt cycles have always ended when excess leverage collides with economic reality. Trust is the invisible foundation of every financial system. Money itself is nothing more than paper or digital entries unless people collectively believe in its value. The moment that trust erodes, the system begins to fracture, regardless of how sophisticated it appears on the surface. Throughout history, we have seen that when governments borrow excessively, print aggressively, or devalue their currency to escape the weight of debt, confidence in money declines. Once people doubt whether the currency will hold its worth, they seek alternatives: gold, foreign assets, or anything perceived as more stable. That shift is the beginning of a breakdown in the monetary order. This erosion of trust does not happen overnight. It builds gradually as citizens see prices rising faster than wages, savings losing purchasing power, and policymakers promising solutions that seem to postpone rather than resolve problems. As inflation persists, or as money creation becomes the default response to every crisis, people begin questioning whether the system is being managed responsibly. Markets respond by demanding higher returns, investors hedge by moving away from the currency, and ordinary individuals start losing faith in their institutions. When the monetary order weakens, the consequences ripple everywhere. Trade partners reassess their willingness to accept payment in a currency they believe is being debased. Allies and rivals alike begin adjusting their reserves, seeking balance outside the dominant system. Internally, inequality worsens because those closest to financial assets benefit from rising prices, while the majority struggle with higher costs of living. The result is social tension layered on top of financial fragility. America is now facing signs of this dynamic. The trust in dollar, once unquestioned, is increasingly challenged by the scale of debt, money printing, and global competition. If confidence continues to slip, the entire foundation of the system risks being tested in ways not seen for generations. Every major financial turning point is defined not only by economic forces but also by the policy responses chosen in those moments. When debt becomes unsustainable and trust begins to erode, governments and central banks face critical decisions. These choices often determine whether a crisis can be managed in a controlled way or whether it spirals into something far more destructive. The dilemma is straightforward. Policymakers can either take the painful but stabilizing path of discipline, reducing spending, restructuring debts, raising interest rates, or they can attempt to delay the pain by printing more money, increasing deficits, and artificially propping up the system. History shows that the latter is far more common because it feels easier in the short run, but it usually amplifies the long-term consequences. At these inflection points, the temptation to avoid immediate pain often leads to policies that debase the currency, distort markets, and widen inequality. For example, keeping interest rates artificially low can stimulate growth temporarily, but it also inflates asset bubbles and discourages real productivity. Excessive government spending can maintain social stability in the short term, but when it is financed by debt and money creation, it accelerates the erosion of trust in the system. These decisions may appear to work for a while, yet they push the economy further into imbalance. What makes these moments so dangerous is the narrowing of options. By the time debt is excessive and rates are near zero, traditional tools lose effectiveness. The only remaining levers are politically unpopular or socially disruptive. Choosing the harder path requires courage and foresight, but history shows it is rare. Instead, most leaders postpone the reckoning, shifting the burden onto the future. This is why today's policy choices matter more than ever. They will shape not just the trajectory of the economy, but the stability of the entire financial order for decades to come. Every financial crisis is shaped not only by internal weaknesses, but also by the external environment in which a country operates. When the balance of power in the world begins to shift, the vulnerabilities of a nation's financial system are exposed more sharply. For decades, America has enjoyed the privilege of leading the global order, with the dollar serving as the dominant reserve currency and U.S. institutions setting the rules of global trade and finance. That dominance created advantages: cheap borrowing, international trust, and unparalleled influence. But no system remains static forever, and history shows that empires and financial powers rise and fall as economic strength, innovation, and military might shift across nations. Today, the world is witnessing a transition. Rising powers are challenging the status quo by building alternative trade networks, diversifying reserves away from the dollar, and questioning the reliability of American leadership. The rapid economic ascent of countries in Asia, the increasing use of regional currencies in global trade, and growing skepticism about America's debt sustainability all point toward a rebalancing of influence. This does not mean an overnight collapse of U.S. dominance, but it does suggest that the uncontested role America once held is gradually weakening. Shifts in world order rarely happen peacefully. They are often accompanied by economic conflicts, trade wars, technological competition, and geopolitical tensions. These struggles create uncertainty in markets and pressure on domestic economies. For the United States, facing both internal fragility from debt and external competition from rising powers magnifies the risks of crisis. When global confidence starts to move elsewhere, the cost of sustaining domestic imbalances becomes even higher. The changing world order is not just an abstract idea. It is a reality that is shaping the environment in which America must navigate its already precarious financial position. In times of financial uncertainty, the most important question becomes how to protect oneself from risks that cannot be fully controlled. History shows that crises are rarely predictable in their exact timing, but the patterns leading up to them are often visible. Excessive debt, rising inflation, eroding trust, and geopolitical tension all signal heightened vulnerability. While individuals, businesses, and governments cannot eliminate these risks, they can position themselves more prudently to withstand shocks when they arrive. The essence of risk mitigation is diversification across assets, geographies, and even currencies. Relying too heavily on one form of wealth, whether it is cash, equities, or real estate, leaves people exposed when that particular area comes under strain. Holding a mix of assets that tend to perform differently under various conditions creates balance. In past periods of crisis, gold, commodities, and certain defensive investments have helped preserve value when paper currencies and stock markets faltered. Similarly, spreading exposure internationally can act as a hedge against domestic instability. Prudent positioning also requires liquidity and discipline. Many investors are caught unprepared in crises because they are over-leveraged or fully invested in speculative assets. Keeping reserves and avoiding unnecessary debt allows flexibility when opportunities or dangers arise. Businesses, too, need to manage costs, strengthen balance sheets, and prepare for disruptions rather than assuming conditions will remain stable. On a broader scale, risk mitigation involves accepting that crises are part of cycles. The aim is not to avoid them entirely, but to reduce the damage they cause and preserve the ability to recover. Those who prepare with patience and foresight often emerge stronger, while those who ignore risks are forced into desperate decisions at the worst possible moment. In uncertain times, resilience becomes the greatest investment of all. Let me leave you with this. Crises are not fate. They are consequences of choices. We are standing at a pivotal juncture. If we act with humility, discipline, and foresight, we may steer through the storm. But if we double down on denial, debt, and distortion, the collapse will be brutal, painful, and avoidable. I urge every one of you, do not watch passively. Engage, question, prepare. The stability of our financial future depends not on hope, but on wisdom, courage, and responsible action. Thank you.